Hello everyone, and welcome to Chapter 27 of my CRT YouTube series. In the last chapter, we discussed my personal approach to high time frame analysis. I shared everything you need to know about how to conduct your analysis in the best way possible. Not only in the best way, but also in the most objective, mechanical, and systematic manner on the higher time frame. However, as you know, our analysis doesn't stop at the higher time frame. In fact, that's just the beginning. The analysis must then be continued down to the lower time frame in a top-down manner, integrating all levels of analysis to properly form a directional bias for the lower time frame. This allows us to refine our entry framework and ultimately execute our entry model effectively. In this chapter, we'll be focusing on intermediate time frame analysis, my personal approach to it, and how to refine the monthly analysis down to the weekly and daily timeframes. So without further delay, let's get into the chapter and discuss the details. The focus of this chapter, and the entire analysis, is, first and foremost, to determine the impact of the higher time frame on our respective asset pair or instrument. Next, we will identify and establish the directional bias and draw liquidity for the weekly time frame. This involves refining the higher time frame's monthly draw on liquidity down to the weekly level in a systematic manner. We will determine both short-term and long-term draw liquidity accordingly. Additionally, we will discuss the correct dealing ranges, how to properly select them, and, more importantly, how to identify the key levels within those ranges. All of this analysis will lead us to conduct a detailed examination on a weekly basis. This is the type of analysis that should be carried out at the beginning of each week to determine our directional bias for the days ahead. Moving on. Here, you can see all the concepts we'll be using to conduct our analysis on a weekly basis. You'll notice that these are the same concepts we applied to the monthly time frame. That's because we don't need any new concepts. Rather, we are refining and integrating the higher time frame analysis with the weekly analysis to narrow it down to specific details. We'll be working with the open, high, low, and close, market profiles, order flow, and other essential concepts. All of this will lead us to determining our directional bias and liquidity, ensuring that both are clearly defined and measurable. Now let's move on. In this slide, we're going to break down the step-by-step approach for intermediate time frame analysis using the open high-low close OHLC concept. First, we will dissect the current monthly and weekly candles based on the OHLC concept. This means studying the behavior of these candles to determine where we are in the current sequence. Are we building liquidity? Are we consolidating near the weekly or monthly open? Or are we preparing for a candle range expansion? This analysis will help you map out the narrative for intermediate time frame analysis. Next, we will build a price-based narrative to anticipate and predict how and when price will move toward the drawn liquidity. Once you understand the candle sequence, you'll craft a structured story and ask yourself, where is price likely headed? Are there liquidity zones above or below the market that it is targeting? Finally, you will support your narrative with the high time frame analysis you've already completed. You'll use insights from the monthly time frame, including key levels and candle ranges, to validate your predictions and expectations for the weekly time frame. This ensures that your intermediate analysis aligns with the bigger picture and the broader market context. Moving on, in this slide, let's break down the process of using market profiles for intermediate time frame analysis. First, you need to determine the current market profile. Ask yourself, are we in an expansion phase where price is trending in a clear direction? Or are we in a consolidation phase where price is range-bound? This step forms the foundation of your analysis because once you understand the market's current behavior, you can make much more informed decisions. Next, refine these profiles into advanced profiles. Once you've identified whether the market is in consolidation or expansion, take it a step further. Ask yourself, is the market showing signs of a reversal, a retracement, or does it intend to continue its trend or range expansion? This refinement will help you narrow down what is most likely to happen next. Then, look for supporting ideas to validate your premise. This is where you challenge your own analysis by asking logical and critical questions. Does the price action confirm my expectations, or does it contradict them? Is there evidence to support my assumptions, or does the market suggest an alternative scenario? Finally, integrate your findings with your higher time frame analysis. Use the insights and analysis you've already conducted on the higher time frame, including key levels and trends, to confirm alignment. This final step ensures that your intermediate time frame analysis aligns with the broader market direction and provides a clear, well-supported narrative. Once you've completed all of that, the next step is to determine the order flow. First, you'll analyze the market's order flow by assessing the overall trend. This involves identifying whether the market is in a state of expansion or consolidation. You need to determine if the price is rejecting lows while breaking highs, or rejecting highs while breaking lows. Next, evaluate whether the price is interacting with short-term, intermediate, or long-term highs and lows. Is the market building liquidity, consolidating, or preparing for a potential breakout? If price is ranging, you'll need to identify whether it is showing signs of a reversal, a retracement, or a continuation within the current trend. Finally, after determining the overall order flow, bring all these observations together to gain a clearer understanding of the market's direction. This step ensures that your intermediate time frame analysis aligns with the bigger picture, reinforcing a well-rounded perspective before making trading decisions. Moving on, in this slide, we're going to dive into the step-by-step process of using market profiles for intermediate time frame analysis. First, after determining the impact of the higher time frame on your chosen asset pair or instrument, you'll break down the selected price range. You'll start by identifying the broader structure and then divide it into premium and discount zones. These zones will help you understand potential areas of interest where price action is likely to react. Next, you'll identify the key levels within these premium and discount zones. It's important to select these levels based on the overall market context and narrative, ensuring they align with the higher time frame analysis. Once these key levels are identified, you'll further refine your understanding by analyzing whether the market is showing signs of reversal, retracement, or continuation. This step is crucial in determining how price is likely to behave in the upcoming sessions. Finally, you will integrate all these observations, market profiles, order flow, key levels, and price action, to develop a well-structured, objective view of the intermediate time frame. This will help you accurately determine the directional bias for the week and make more informed trading decisions. Now, moving on to this slide, you can see a summary of the entire process. First, I started by determining the current market profile. This involved identifying whether the market was in a consolidation, expansion, reversal, or retracement phase to understand the current market conditions. Next, I measured the order flow by analyzing how price interacted with key levels. Based on this structure and framework, I was able to determine the market's directional bias. To further validate my analysis, I compared related markets and correlated assets. This helped strengthen my confidence in my findings by ensuring that the directional bias was supported across multiple instruments. After that, I selected a portion of price action to focus on, known as the dealing range. This step narrowed my focus to a manageable and relevant area of the chart, where I identified key levels and candle ranges to support my trade ideas. From there, I refined these key levels further within the CRT framework on my chosen time frame. This entire process ultimately led to defining a clear directional bias on the weekly time frame. From this point, I would refine my analysis even further by applying the same methods on the daily time frame, making the process even more precise and accurate. Moving on, here you can see the monthly chart from the previous chapter. What we had done was identify a key swing low, which was taken out by this particular candle. This candle then acted as a reference for our candle range. The swing low served as a critical key level for our analysis, forming the CRT candle range for us. Once the CRT was purged and price closed higher, we observed price expanding upwards toward the drawn liquidity, which was the swing high. By refining the analysis down to the weekly time frame, you can see that once the swing low was purged, an order block formed right here. Price then engulfed this particular candle, which turned into an order block. After testing this level, price expanded higher. Traders, I hope you understand this chapter. If you have any questions regarding this video or CRT in general, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames Yen Trading. Once you're satisfied with the results, be sure to forward test your favorite strategy on a demo account. Remember that nothing in this video should be considered financial advice. This is purely for informational purposes. If you haven't already, please consider liking this video and subscribing to my channel so you don't miss out on future content. I upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. Thanks for watching. Till next time, happy trading.
Would you like to earn up to $10,000 just from sign-up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.